Today we're going to talk about tax-free savings account, otherwise known as TFSA. The tax-free saving account was introduced by the Canadian government and put into place in January 2009. The tax-free savings account allows tax-free growth of investment income as well as capital gain and provides flexibility for redemptions and contributions. Now let's talk about contributions. Because of the tax-free aspects of the TFSA, the government imposed maximum contributions inside the account. Moreover, in order to be able to contribute inside the tax-free saving account, you must be a Canadian resident and be age of at least 18 years old. It is important to take into consideration your age when it comes to contributions inside a tax-free savings account because it will allow you to know how much you can contribute inside the account by 2021. For example, for a person who was 18 years old in 2019, they will only be able to contribute up to $18,000 in the TFSA for 2021. That would mean $6,000 for 2019, $6,000 for 2020, and $6,000 for 2021, versus a person who is age 18 years old in 2009, or at least 18 years old in 2009, would be able to maximize the 75,500 contribution space inside a TFSA by 2021 if they've never contributed to a tax-free savings account before. Also, contribution room automatically accumulates each year, and for any unused contribution space, no worries, it gets carried forward indefinitely for subsequent use. It's important to note that there are no tax deduction on contributions into a TFSA. However, an over-contribution into the account may result in a tax penalty. Concerning withdrawals, withdrawals are tax-free and allowed at any time and for any purposes. When you withdraw an amount from your tax-free savings account, you can recontribute it into the account starting the following year in order not to impact your contribution space. However, if you decide to recontribute the amount the same year into the tax-free savings account, then you must take in consideration your contributions room, because if you didn't have enough room in that account, the government will see it as an over-contribution and then you'll be affected by a tax penalty. Now, in the next couple of slides, we'll see examples of who can benefit from a tax-free savings account.
Investors new to the workforce do not have to wait and earn any contribution room as they would with RRSPs. This means that any individual over the age of 18 just starting a career may use the tax-free saving account while building their RRSP contribution room to use in later years when they are in a higher tax bracket. Another example are people saving for education. Since 18 years old are no longer eligible for registered education saving plan grants, the TFSA can be a great way to save for post-secondary education. Money can be withdrawn from the account for any reason, even if the post-secondary education is not pursued, unlike with the RESPs. Future home buyers. Rather than contributing to an RRSP and then borrowing those same funds through their home buyer's plan, investor can save for their home by contributing to a tax-free saving account. When the funds are taken out of the TFSA to pay for the home, there are no taxes to be paid on any growth or investment income distributed into the account. Also, unlike the home buyer's plan, money does not have to stay into the account for 90 days prior to be eligible for withdrawal, and the funds do not have to be paid back. Final example would be seniors and those concerned about clawbacks. Senior can save and still collect pensions such as old age securities when they use the tax-free savings account. Since investments earning and withdrawals are not reported on one's tax return, this eliminates the possibility of clawing back any benefits such as the old age security. That's because income and withdrawal from a tax-free savings account will not affect their eligibility for these benefits and credits.
The bottom line with tax-free savings account is because of the tax-free aspect of the account, it should be considered as an important investment strategy.